Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
Okay, no good jokes for zippers. All right, hey, welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, that specific journey, that financial journey, is going to take you all around the world because we are going to be talking about emerging markets.
All right, so we're talking about when a country is trying to get on the highway from the on-ramp?
Not exactly.
That's merging markets. Oh, I'm sorry. So these are new countries emerging, coming out, so like Wakanda, right?
Okay, so speaking of Wakanda, I have yet to see Black Panther.
Oh, it's a great movie.
It's on Disney Plus.
Yes.
It's on the list.
You're
My brother-in-law is a big Marvel fan. And so he and my sister and my wife and I are slowly working our way chronologically through the Marvel universe. And we're through the 90s. So we got through Captain Marvel. We've watched 2.
Okay. It's good.
We have a little ways to go, but we'll get to Black Panther eventually. But first of all, in case you didn't know, Wakanda does not really exist.
What?
So,
oh man,
mind blown there.
They don't have that cool
but that
technology.
is a topic for another day.
Yep.
So don't be buying like bonds from Wakanda. Someone would sure be ripping you off. But what we're talking about is the actual existing economies that are emerging in terms of their economic leadership in the global economy, and specifically investment into their economies, and whether that be through debt or equity vehicles. So investing into the economies of markets that are not quite developed in terms of mature economies.
Okay. So emerging mean they're coming on to more the developed stage.
Right.
Not that they're a newly established country that, just showed up on the map.
Yeah.
It's a country that's been impoverished or third world, but is making technological advancements in infrastructure to move towards a more developed system so that then they can compete and trade with other countries.
Or even, it's a funny thing. So when you think of emerging markets, Greece is technically an emerging market, but they have one of the oldest economies on the planet. So you don't necessarily have to have limited economic history. I think it's really about growth and about coming to development to catch up to the major Western Europe or United States or level of technology and infrastructure, like you said.
Because Brazil fits in there as well.
Yeah,
and they hosted the Olympics, so they obviously have the infrastructure there to host the Olympics, but they're still considered emerging. Okay.
Exactly,
good deal. So. Is this new, emerging markets? Obviously, we just talked about some countries that have been around for a long time that are classified in here.
Yeah.
But is investing in emerging markets, is this something new or has this been around?
Well, that's a tricky question. So first of all, way back in the 80s, so like when you were born.
Yes.
Specifically in 86 to 87, that time frame, a little bit more than 30 years ago, MSCI Global is a global leader in indexing and data and benchmarking. They founded the Emerging Market Index.
Okay.
So about 30 years ago. So we can trace back the way we think about and talk about emerging markets about 30 years as far as like a grouping, like an index or a benchmark. But exactly what even defines an emerging market, that's even debated today. But think of it this way. It's a way of looking at a group of global economies that are in a higher growth phase in their life than that of more developed, established economies like the U.S. or Western Europe.
Okay. So I am older than this index.
True.
That's pretty cool. So before I was born, were there any ways that somebody that wanted to invest in that could do that before this index was created?
Are you ready to buckle up and get a little nerdy?
Let's do this.
Because there was a great article that I read, and we'll link it in the show notes, from Business Insider. So they put together the article, which was done based on the research from a company called Renaissance Capital. And Renaissance Capital dug into the weeds of investing in emerging markets. So let's go. We're going to take a step way back. We're going to start back in the 4th century BC. And this was actually in Greece. So the 4th century BC in Greece, 10 Greek municipalities belonging to the Attic Maritime Association defaulted on their loans from the Delos Temple. So this kind of reminds me of the Greek debt crisis, the banking crisis
They've been doing this
a
for a
couple
long
years
time.
ago. It's like all over the place.
They never
with
learn their
Greece.
lesson.
But Greece, like I said earlier, they would be considered an emerging market today. But back when this occurred, they were like the philosophical, technological, intellectual capital of the world. So it's kind of come full circle.
Yep.
So that's 4th century BC. So flash forward about 1,000 years to 2,000 years. About 2,000 years to 1602. 1602, the Dutch East India Company is founded. And that was the first joint stock company to have freely tradable shares. And based on the fact that my wife and I have been watching a lot of Pirates of the Caribbean lately, Disney Plus, woo woo, they talk about the East India Trading Company and at least the first one a lot. So, and the second one I think too. So, Dutch East India Company talking about trading. It's interesting that goes back that far. So flash forward another 120 years, 1720, the South Sea Bubble. That was a key point for emerging market investing. Even Isaac Newton fell for this one. He was one of the smartest people ever to live. We did an episode where we talked with Ben Carlson about his book, Don't Fall For It, A Brief History of Financial Scams. Also throw that in the show notes, where we discuss this very bubble. But that was a very interesting situation.
Yeah, that's a great book to read because it takes some of those. And again, you don't have to love finance to really find that book intriguing because it talks about really the ways that people get tricked into this whole or get caught up in the hype of these type of bubbles and bought into it. This being one of them. Yeah, that was good.
So another 40 years later, in 1763, Baring Brothers opens. The firm financed the Louisiana Purchase in 1803. So we know the Louisiana Purchase here in the United States specifically was a big deal for, that part of the country. So flash forward another 40 years. N.M. Rothschild and Sons opens its London office. The Rothschilds organized the financing for the first attempt at an underground channel between France and Britain. Think about that. 1804, they're already talking about a channel between France and Britain underground. That, I don't know how in using 1800 technology that would have happened.
Just digging with a spoon. We'll get there.
We'll get there by about 1940. So anyway, that was 1804. They also financed projects for Britain's purchase of Egypt's share of the Suez Canal in 1875. So lots going on there. Lots going on in the early 1800s in general. Between 1822 and 1824...
I want to pause real quick.
Oh, boy.
So it took me a while to catch on to this, but the one in 1763, the Baring Brothers opened the firm where they financed the Louisiana Purchase.
Yes.
I'm thinking, what does that have to do with emerging markets? That's the United States, the developed country.
Think about it.
Then I realized we were the emerging market.
We were the emerging market of the world.
Yeah, just colonies hanging out, doing their thing, and becoming independent, and wow. So that was us.
So, think about that. Someone had a way to invest in the United States before it was the United States. They probably made a pretty penny.
Crazy.
Over time.
Compounded.
Time is the key there. So between 1822 and 1824, bonds were floated in London by Colombia, Chile, Peru, the province of Buenos Aires, which is actually in Brazil. Also, Brazil itself was a different, separate from that at that point. Mexico, Guatemala, Greece, and there was even an imaginary bond floated from Pois.
What was that?
It's kind of like Wakanda.
Yeah.
But I think it was a scam that went on back then. And so this is kind of the early periods of investing in emerging market debt. And London was obviously the biggest stock exchange in the world at that point in time. But typically, you think of emerging markets as, at least I typically think of emerging market as buying equities, stocks from emerging market countries. But emerging market debt is just as big as emerging market equity. So that's 1824. Then the next year in 1825, the London Panic of 1825 triggered a bunch of sovereign defaults. First, Peru defaulted, and many others followed after that. All Latin American issuers except Brazil were in default by the end of the decade. So lots of volatility and choppiness already we're seeing in emerging market investing. Emerging market default and debt markets they were and have been kind of all over the place. So in the mid-1800s through to the early 1900s, what we would consider modern emerging markets kind of began to emerge. So Russia was the first to see trading of shares in about 1830 at the St. Petersburg Stock Exchange there. But it ceased to be a market economy in 1917 after the revolution. Same thing kind of happened in China in 1949. So again, you're picking up on the theme of volatility. There is a lot of issues of things look good, things sound good, things are going well, things fall apart. That is a very common theme with emerging markets investing. In the 1930s, over 40% of countries that this company, Renaissance Capital, could find data for, they were in default by 1936. 40% of those countries, that is a ton. And then the Great Depression fueled a collapse in global trade, which triggered even more sovereign debt defaults. So then we get into World War II, which was obviously tough. And after World War II, emerging markets tended to borrow only from banks and multinational organizations in dollars or other hard currencies, so they were taking some of the currency fluctuations from their economies out of the situation.
Yeah, because you may have an emerging market that has their own currency.
If their currency's going wonky.
And the government says, hey, you know what, let's just start printing a bunch, and then you got people with wheelbarrows of money moving around. And then if I'm an investor overseas, all of a sudden, if I'm owning it in local currency, I'm in big trouble because they just devalued it like crazy to help boost their, the government helped to boost their position, and I just got hurt.
Yes.
So, that makes sense why they'd move that way.
So then in 1971, the Bretton Woods Agreement collapsed, and we talked about that in a different episode as well. We're going to plug that one too. Put that in the show notes. That was the episode about the gold standard, our silver episode.
That's right.
So we'll link that in the show notes as well. But U.S. banks continued to lend to emerging markets during this time, even though there was an oil crisis going on. There was inflation shock and recession, not only in the U.S. but around the world. So check that episode out. But we did go into a little bit more depth on the Bretton Woods Agreement there. So between 1979 and 1980, the U.S. Federal Reserve hiked interest rates to 20%. So wow. That's a lot of, if you think of, we're in this world of pretty much no interest rates.
0.25.
So 20% was a lot. And I'll quote, this is the quote from the company who did the research for this. The associated dollar spike and an increase in interest costs combined with the world economy entering a recession in 1981 saw Mexico as the first to announce that it would no longer be able to service its debt in August 1982. So not a good time for Mexico, which even today would be considered an emerging market, but back then was also considered an emerging market.
Yeah, so if the U.S. debt, being a developed country with arguably one of the most stable economies in the world, is having 20% interest rates, then if I'm going to be enticed to go elsewhere, what is emerging market offering at that time? I mean, it's just ridiculous. Yeah.
For the risk.
Yeah, that's why they couldn't afford it. 40% interest rate or something. Who knows what it was? That's crazy.
So this caused, throughout the 80s, U.S. banks, which were already a little overexposed to emerging markets, to pull back on their lending, which led to further defaults by these because they couldn't get the loans. They couldn't get the underwriting for their debt. It was a situation. So this crisis really hit Latin America pretty broadly. But Eastern Europe and Africa also had a lot of impact from that. And the 80s were rough for emerging markets. So, 1989, the Brady Plan was formed, and that was named after then U.S. Treasury Secretary Nicholas Brady. So that happened, and then there was a drop in global interest rates, which eventually helped end the crisis. So things got really, really choppy in the 80s, and they did settle down towards the end of the decade. So in 1998, and I quote again from the RenCap team here who put together a great research piece. After a decade of defaults, all major Brady restructuring were completed and had resulted in a liquid, easily tradable market of hundreds of billions of dollars of standardized dollar bonds issued by emerging markets. Over time, more traditional hard currency bonds started to be issued and Brady bonds retired. So this was a time of stabilization that really started. The 80s were pretty rough. The 90s got more stable. And they had a lot of backing and help from the U.S. in pulling together their debt markets. So the 90s were better.
So we saw more stability, but still had volatility. I mean, there was still volatility. But we weren't seeing the defaults of a whole country like you had in the past.
Yes.
Okay.
So then in 2001, Goldman Sachs the company Goldman Sachs, their own Jim O'Neill coined the term BRIC, B-R-I-C, which stood for Brazil, Russia, India, and China. And then also added South Africa in 2010, making the term BRICS. And that's kind of something that people think about when they think about emerging markets. Is those are like the big emerging markets that people can invest in and really have a lot of infrastructure and a lot of financial security behind them compared to some other smaller economies.
So since we were talking about fake economies added into this, if you had the Lord of the Rings added into this, would that be bricks and mortar? Oh, I've just about made him spit out.
I just took a sip of tea. Bricks and Mordor.
Yes. Oh, I'm sorry, I had that wrong.
Bricks and Mordor.
Okay.
So, yeah, brick.
Yeah, BRIC. But
Bricks.
That's a good way of remembering. When you're thinking emerging markets, Brazil, Russia, India, and China are the big countries that make up a lot of that index, if you look at that standpoint, especially China. I mean, it's huge.
I mean, it's the second biggest in the world in terms of at least equity markets.
Yep. And well, speaking of China,
economies.
I mean, well, if you look at China, should that even be an emerging market anymore? That's the big question. A lot of people ask that. And so, looking through that, Forbes had an article. It was actually a couple of years ago they published this, so I'll have it in the show notes. But in it, they were kind of highlighting that, and this is still true today if you look at the index and the ETFs that track the index, China makes up 1/3 of the total index. So when you buy into an emerging market index, you are buying 1/3 of that whole thing is just in China, in China countries or the companies within the country. And it's 3 times the size of the next largest country, which is South Korea, which arguably is probably more developed or more on the line of being developed than China as an overall economy. And they're 3 times the size of that. And of the top 10 holdings, if you look at kind of the larger traded ETFs, 6 of those companies are from China, and no other country has more than 1 in the top 10. So it makes a big piece, and what happens to China really moves the needle on emerging markets. Yes. But if you look at the progress they've made, are they still emerging market? I mean, look at some of their cities are very developed. I mean, they rival any other city across the world in technology and comforts that are offered.
They also have a lot of wealth that's been generated.
There's a lot of wealth in there, yes. And if you look at the, speaking of wealth, no other country has, outside the U.S., has more billionaires than China.
Wow. And I'm sure that was not the case 40 years ago.
No.
This is all new. This is new money.
It's just worth thinking. Now, again, if someone decided, hey, you know what, China's not an emerging market anymore, think of the chaos that would ensue for this whole investing complex of ETFs and everything that tracks this index of what is and what isn't emerging markets. So it's kind of, once you're in that category, if you're big, you're probably going to stay there for a while, or at least find some way to transition out of there without causing that disruption.
And I think that I've seen some ETFs and maybe some funds or some indexes that are now starting to exclude China because of their are they really an emerging market in terms of size?
Yes.
Arguably not anymore. So if you're really looking at that emerging side of things and the things yes, China's obviously still growing very quickly, but in terms of size, they're second largest economy in the world. There's not a lot of up to go.
Yeah, and but China's a huge place. If you leave those cities, you do see the developed part of that that still needs to happen.
Yeah.
I mean, there's a lot of places in China.
Rural China is very rural China.
Yes. Yeah. So, you can make an argument both ways. Just because they have some large cities and a lot of their wealth is concentrated in one spot, does that make the whole country no longer emerging, or do they still need to expand that way and get more and more developed?
Exactly.
All right. Let's take a break real quick.
Ooh.
Dad joke of the week. All right. So here we go. Just a question for you, Austin. Do you know when a normal joke becomes a dad joke?
I usually refer to that as the point when people stop laughing.
It's usually when people roll their eyes, but here's the actual answer. A dad joke happens when a regular joke becomes apparent. So when it's apparent.
That's a good one. That's a good one.
That's what I have for today.
Hey,
and then
that's good.
Quick follow-up. I wouldn't buy anything with Velcro. It's a total ripoff. Just keep that in mind and when you're going shopping. All right, so back to where we're at. From all this history that we just talked about, you're walking through from all the way back in 4th century BC all the way up through the early 90s and into the 2000s, where we've seen more of a streamlining and more of a classification and kind of boxing in what an actual emerging market is. Where do we go from here? There seems to be a lot of risk in this. There's obviously defaults. We talked about that. Countries defaulting, not just, when we talk investing with companies, sometimes, they may default, go into bankruptcy. But we're talking countries defaulting on their loans, okay? So assuming it's volatile, that's what we see.
Yeah.
Talk a little bit about what we've seen on that track record.
Well, so if we go back to where MSCI started tracking emerging markets kind of the way we think of them today, so that was back till 1986 or 87. So around that time, since then, the MSCI Emerging Market Index has returned a total of 825%. So that's a little bit.
That's a lot.
That's
of
a lot of percent. That's a little bit more than 7% annualized since the beginning of 1986, excluding dividends. So take dividends out of the situation. By contrast, the S&P 500, which is kind of the easiest benchmark to think of for United States equities, has returned a total of 1,144%.
That's more percentages.
That's more percentages. So that's almost 8% annualized over that same period, again, excluding dividends. So not on a 1 year, so an annualized percentage, not a huge percent different, not even 1% in terms of annualized percentages. And I would say they're probably even a little closer because when you stray outside the U.S., you typically get a higher dividend yield in a lot of developed markets. Yes, I think of Europe for one, but emerging markets as well. Dividends are a way that you can get a better yield oftentimes outside the U.S. So that may even total return be a little bit narrower than that. Where things are different is how these returns are generated. So U.S. stocks have for sure had their fair share of bear markets during this time, and we're on our way out of one right now as we're recording this. But the volatility that you have to withstand with emerging markets is significantly more even yet. So, 1 year, they're going to rip the face off the S&P 500 and double it in terms of stock market performance. But the next year, it's going to be down 20%, while the S&P is up 2 or something. Like, the swings are very, very, very all over the place. And recoveries are often less stable or less predictable and more choppy as well. And that's something that is at least worth considering, with where we are at in this global COVID-19 recession that's happening. It's going to take some time to come out of it. And I think the U.S. has at least an understanding of what it's going to take to come out of it. But there's going to be maybe a little bit more bump in the road for some of those emerging markets.
Because they almost have to wait for us to come out before they follow suit. Because if they're relying on us for infrastructure or those type of things, then or just the appetite to buy the higher yield of the debt that they're offering or the stocks. Yeah, you're right. It could be very choppy.
Exactly.
But you can invest in it. So tell us, what are some of the ways you can invest in this trend?
Well, I want to say, as usual, that I am not advising anyone to go out and buy anything I'm talking about here, especially when it relates to emerging markets. They have even more risk than United States equities or whatever. They're a lot more volatile. But there's definitely ways to gain exposure to this theme, to this trend, and to this big part of our global economy that is growing. But always talk to your financial advisor, see if it's something that fits your risk tolerance and your overall financial plan. But anyway, some ideas. Think about individual stocks, companies that you know or have heard of that are based out of the United States. So companies like Alibaba or Tencent out of China, companies in Russia, Brazil, Eastern Europe, Africa, individual companies you can invest in that are based outside the United States. So a lot of times in the United States, you can get what's called an ADR or an American Depository Receipt, and that is where you can invest in foreign shares of a foreign company in U.S. dollars that are held and registered here. It's safe, it's.
And you get a receipt, so you purchased it.
You can hold on to it in your pocket.
So another, like South Korea, obviously we mentioned is one of the emerging markets.
True.
Samsung, I think, is there.
Samsung is there.
A company you're familiar with, you look at, like, that's what my phone is, or you see the TVs and all the cool stuff. But like, you could see a company and say, okay, there's one that, if I do my research and I like where it's at, at least I know what it is and what it does. You don't have to go buy something you never heard of. There's countries that have companies within them that are, globally.
And think of things like Hyundai.
Yep.
those are things. So funny story. I make fun of you frequently.
Yes.
For your Samsung phone.
A great phone. Yes.
But I have an iPhone and I'm an Apple guy. I love my Apple products. So I have an iPhone SE, which is the last small iPhone you could buy.
It was created in 97.
When I was 6. So I hate on your phone all the time, but I bet your phone's never done this. Today, my phone all of a sudden started vibrating like a notification, but constantly for at least 5 or 10 minutes, and I restarted it like 3 or 4 times.
It just was going.
And then it stopped, and it's been fine ever since. Huh. So speaking of Samsung,
maybe that was the time to upgrade your phone alert.
So I told our colleague Adam about that, and he said, "Yeah, I think that's the Tim Cook alert on it's time to go buy a new iPhone."
Yes.
So anyway, back to emerging markets. iPhones are made in China. That's an emerging market.
Yes.
There you go. You can also gain exposure, and this is one of the ways that I would say is probably much easier to understand, is through ETFs or exchange traded funds, which often mirror indexes or whatever. There's a couple where, like iShares Emerging Markets ETF, ticker EEM. That is literally, it's meant to mirror the index. And they're very affordable ways to gain emerging market exposure. Wisdom Tree Emerging Market Corporate Bond ETF, EMCB, Van Eck Vectors Emerging Market Aggregate Bond, EMAG. You can also go the other way of anti-China. You can go full China. You can say Crane Shares MSCI All China Index, KALL. So those are some ETFs to do that. Also, mutual funds are a good way to get exposure through this. And this is a great thing where I think, especially with emerging markets, if you just buy the index or you buy, a passive vehicle, you're going to get a very cheap cost for that. You're going to pay low fees, low management fees for that. But I think some active management when it comes to emerging markets could be very, very valuable to kind of weed out the things that you for sure don't want to be invested in, where the passive things are just going to be in there like the index would be. So I think some things like Oppenheimer Developing Markets is a fund that's very well run, very good active management. Most large fund managers should have an actively managed or probably do have an actively managed emerging market fund. It's going to be a little bit more expensive than something passive like an ETF. Also,
developing market, emerging market, there's terms that are kind of interchangeable here, like New World. The idea that you may not see emerging market necessarily in the title, but something indicating that it's not the more developed worlds, but developing or new or emerging, those type of things is what you're looking for if you're trying to invest in those.
And your financial advisor would know if you mention emerging markets or any of those terminology, they should know and be able to point you in the direction of what they would recommend for your situation. So, Josh, it's time to put on your CFP hat. You're a CFP, Certified Financial Planner. Put on your CFP hat.
They have to sell hats with that logo on.
I know Jess has one.
I don't have one, though.
So what role can emerging markets play in a well-balanced portfolio?
All right. So first and foremost, one of the biggest roles it plays is in the diversifying of your portfolio. So we always talk about this, why you need to be diversified, because if you own only one individual thing or one individual sector, or even if you go all the way down to one company, you're going to follow whatever they're doing up and down. And so diversifying, spreading out, helps smooth out those ups and downs. And so another way to diversify is to leave the developed world and end up in the emerging market world. And so that just, like you mentioned, they don't always follow suit with what's going on here in the U.S. or in Europe or wherever else. And so that helps diversify. So that's the big thing. Like you mentioned, those ETFs or mutual funds, they also then further diversify. If you're not buying individual companies, the ETF or mutual fund will hold a basket of goods. And so you're, again, spreading it out. So I'm not holding, if I want 10% emerging markets, I'm not buying one emerging market company and saying, look, I got 10% emerging markets. No, you got 10% of one company.
Yeah, exactly.
You're not diversified. And so you buy an ETF or something like that, you're spread out.
Yep.
And so that's, again, the diversifying thing. Emerging markets tend to react differently. So again, you're spreading out your volatility in that they may not always respond to the same thing. Emerging market debt responds differently than emerging market stock. And same thing as emerging market debt responds differently than developed world debt, like U.S. Treasuries. They don't move the same direction.
Exactly.
And so, again, you're just spreading out what you're investing in. And we always say, a good diversified portfolio should never have all your investments doing the exact same thing at the exact same time.
Right.
If they're all going up, then you're not really diversified as much as you probably think you are.
And you may be happy while it's all going up.
But when it all goes down, you're going to say, I thought I was diversified.
Exactly.
And so, there's always something in your portfolio you should not be happy with. That means you're diversified pretty good. And which sounds weird to say, but it's there for a different reason.
Yeah.
If your U.S. stocks are going up, and for just a simple example, your U.S. bonds are not, it's not because there's something wrong. It's because they're not designed to be up in those strong stock markets.
Exactly.
They're designed to protect in the down stock markets. And so, again, diversification is huge. That's where you can get different types of returns from different types of volatility.
Yeah. So I'm going to put you on the spot.
Yes.
Should you invest in emerging markets right now?
Well, that's a great question. And it really comes back to what you said is working with a financial advisor, because the answer to that question is, I don't know, based on whatever your situation is. If you're trying to build a diversified portfolio, then the answer is probably yes, you should have something in emerging markets because, again, a good diversified portfolio will have a lot of different pieces. So should you be investing now? Now versus another time, it's down as well. We're in kind of a recovery phase after we went through COVID-19, and we saw a lot of markets drop, that they're down in price than they were at the beginning of this year. So from a timing standpoint, everything's down. So investing is kind of a good spot right now.
Exactly.
But we don't know what's going to go on for the future. They're reacting and they're getting impacted differently from COVID-19 than we are.
Yep.
They don't have the infrastructure in the hospitals that we do here in the U.S. to handle a large caseload. And so, again, should you invest in EMN? That's a good conversation with your advisor to say, can I stomach the volatility that may happen from owning this type of investment? And so that's really the end response.
So I guess to sum that up, where and how you invest your hard-earned dollars, whether that be domestic, developed, international, emerging markets, equity, fixed income, mutual funds, stocks, bonds, whatever that might be, it is a serious topic, and it deserves the very best financial planning and advice possible. And Josh and I want to let you know that we're here to help. If you don't have a financial advisor, or if you simply just want to hear more about what we do, and we work at Hicks & Zerker Capital Management, if you want to know what we do here, please check out the Invest With Us tab on our website, and we'll link that below in the show notes. We work with a team of credentialed, experienced colleagues that have worked alongside our clients for nearly 2 decades to help them achieve their financial goals, and we can help you too.
Yep. And as always, on that website, check it out. We got a free gift for you. It's 8 Principles of Timeless Investing. It's free. Just 8 overarching themes to help keep you on track. What else can they do to help us out for this podcast?
Yeah, we would just love it if you'd subscribe. If you're not subscribed already, leave us a review on Apple Podcasts and email us any ideas or any questions at hello@theinvesteddads.com. We will get back to you. We definitely check that all the time. Please share this episode if you enjoyed it with friends and family. We'd really appreciate that.
Yeah. And like we said, the hello@theinvesteddads, that email is for questions that you have as well as topics, because we want you to enjoy listening to this and we want to talk about the things you want to hear about. So if you have an idea, whatever it is, shoot us an email. We'd love to hear it. Thanks for listening, and I hope you learned something new about emerging markets. It is not what I thought it was at the beginning, and so I'm glad I learned what it was supposed to be, and we look forward to talking to you next week.
Yep, talk to you next week. Bye.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.